Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news stories you need to know about from the continent and beyond. But first, a run through the markets. It seems we're deep into results season now. One of Kenya's largest banks reported a decline in net earnings for the fiscal year ending in December to roughly a $27.5 million dividend payout. But KCB, Equity Incorporated Bank, they all closed much higher today, in fact by nearly 4% in the case of the last two. So what is the attraction over there? We'll explore that with Ramah Nyang of EFG Hermes in about 5 minutes. More bank results from Nigeria too. GT Bank reporting a 2.33% rise in net earnings for 2020, $494 million there. Its shares are up by 6% in today's session, but they're still negative on a year-to-date basis. Here's what's coming up tonight. An Italian court has acquitted Shell and Eni in a $1 billion bribery scandal involving control of an oil block in Nigeria. Egypt's government plans to increase spending to boost household incomes amidst the pandemic. And the US Federal Reserve is expecting a strong economic rebound in the US economy this year. Our starting point tonight, however, is in the oil sector. A court in Milan has acquitted the oil giant Shell and Italy's Eni, along with several of their current and former executives, of corruption charges in a $1.1 billion bribery case involving control of a Nigerian oil block. Now, the verdict effectively ends a 3-year legal fight that loomed large over the tenure of the Eni chief executive, Claudio De Calzi, who was among those found not guilty on Wednesday. Italian prosecutors were actually seeking an 8-year jail term for him. They alleged that $520 million of the $1.1 billion paid into an escrow account for the acquisition of that particular oil block's drilling rights were converted into cash and distributed as bribes. Both Anglo-Dutch Shell and Eni, which is 30% owned by the Italian government, have denied any wrongdoing in that particular case. On to some company focus now. One of Kenya's top two banks, Kenya Commercial Bank, or KCB as it's more commonly known, has reported a 22% decline in net earnings for the 2020 fiscal year to $178 million. Now, the bank's stock of non-performing loans made up 14.7% of its entire loan book. That was marginally higher than the industry average at 14.1%. It's also a reflection of the wide economic damage that has been inflicted by the pandemic on the Kenyan economy, where 77% of the bank's assets are located. The bank's CEO, Joshua Oigara, argued that despite an uncertain outlook, there's progress being made in reducing the bank's stock of non-performing loans.
To be two-dimensional in this view. One is the period it's taking for us to be able to be confident about COVID. And number two, some sectors being reopened. So you have some sectors which are a bit held back today, maybe like in aviation, you haven't traveling as much. Hotels, we don't have as many tourists. Schools took longer to open. So we've done 106 billion by quarter 4. But by now, almost 30 billion of those have actually gone back to normal loans. So we have had almost a 35% recovery, if you ask me. And so I'm confident. And so now we're down to almost 70 billion, 72 billion to be exact. So you can see some progress. Yeah, so we see hotels, hospitality industry, but classify that. Some of our customers in manufacturing and aviation, that's we see, and also some real estate. We see some delayed recovery. But on trade, on other segments like education, financial institutions, on energy, we see, that's already picking up.
All right, then, Joshua Oigara there explaining the decline that he's seen so far in the first quarter of 2021 in the amount of loans that the bank has restructured. So let's dig deeper into KCB's financials for 2020. Ramah Nyang is the research director covering Sub-Saharan Africa banks at EFG Hermes. He joins us now live from London. Ramah, good to see you. So roughly 20% of the bank's loan book, that's about $964 million of assets, had been restructured by the end of 2020. But is the bank justified in being somewhat positive about an economic recovery this year?
Good evening, Ramah. Yes, I think there is reason to be cautiously optimistic. If you look at the leading economic indicators, it seems like there has been a strong rebound in economic activity since the major lockdown was lifted in 2Q last year. GDP growth is widely expected to rebound to around 5-6% this year, And that, I think, should lead to a rebound in corporate and SME profits, as well as a recovery in personal incomes, which in turn should be, I think, positive for the performance of our banks' loans. Looking at some of the other economies whose fundamentals are much weaker, we have seen a strong uptick in performance rates, and I think we should see something similar in Kenya. Having said that, I think the one area of uncertainty is the real estate segment, which forms almost 26% of the bank's restructured loans. As you know, there is an ongoing correction in the segment due to oversupply, especially in the commercial and upper income housing segments. So there is a possibility that this segment could take longer to recover, and depending on the magnitude of the recovery, the bank may need to make additional provisions and write-offs for this particular segment.
Let's explore the downside risks in a bit more detail, because looking forward into 2021, 2022, if you look at the Kenyan vaccine rollout plan, that stretches all the way to 2023. The vaccine rollout plan has been relatively slow compared to even peers like Ghana, for example, and it's not 100% clear exactly when the economic drag from this pandemic will essentially be lifted from the economy, especially on household incomes and jobs, as we saw last year. So given that particular outlook, isn't that likely to be a drag on both incomes and, by extension, the interest income and non-funded income that banks will be reporting?
Sure. There's definitely, downside risks, given the potential delay in vaccine rollouts. We still don't know what happens if there's a new variant of COVID, all that kind of stuff. But I would say the outlook right now compared to where we were 12 months ago is definitely a lot more positive. We definitely have a much better idea of just how to live with the virus, and therefore, as a result, I think the banks should be in a better position to navigate through that compared to 12 months ago.
Indeed. So interest income did rise in this particular year, but you flagged an interesting risk moving forward for KCB, whether or not their risk pricing model gets a speedy or delayed approval from CBK. Walk us through that.
Yeah. So, the central bank has certainly taken its time to approve banks' risk pricing models, given that the rate cap was repealed, at the back end of 2019. I'm not sure if the delay is due to COVID-related disruptions or if the CBK is just not satisfied with the models that these banks have submitted. Having said that, if you look at the economy, it is in need of a boost. And the fact that, fiscal policies should be tightening, given the recent deal with the IMF, I think, the central bank will have to do the heavy lifting in terms of uplifting the economy and stimulating growth. So, one way of achieving that is, trying to get stronger loan growth. And I think the only way that they're going to be able to do that right now is approve banks' risk pricing models and allow them to underwrite slightly higher risk loans, such as SME loans. So yeah, I'm reasonably optimistic that the risk pricing models should be approved. And if it is approved, for KCB and I guess for the rest of the sector as well, especially the tier 2, tier 3 banks, I think it should be a positive, as it should lead to stronger loan growth and slightly higher margins as well. Although I think the uptick in margin should be more gradual, because banks will be conscious of the presidential elections in 2022. I'm sure they'll have their memories, they'll remember what happened back in 2016, 2017. And also I think they'll be conscious of the tough operating environment.
Indeed, and I'm glad you brought up the wider social and political environment, because I was going to ask about the converse argument, because the regulator may look at what's happening now, looking especially at the results that are coming out for 2020 from KCB, Equity, Stanbic, the lot, especially the tier ones, and say, well, if you're making money with essentially rates where they were last year, and we've essentially kept a lid on transfer fees as well for bank to mobile money transfers, then we don't actually need to give you guys a break right now. You'll be fine as it is. I mean, isn't that just equally as realistic an alternative?
Fair point. Look, even with the risk pricing models not approved, and even if you look at banks' numbers when the rate cap was in place, the net interest margins for banks was around 7-8%, which, when we look at our universe, it's amongst the highest within the frontier universe. So the banks were making pretty decent profits in that environment. However, there's two things I would maybe clarify within that. Yes, some of the banks were making profits, but by and large, the profitability was concentrated in the
All right, unfortunately, we have lost Ramah Nyang there. We do apologize for that particular problem. Let's move on to retail. Africa's largest supermarket chain posted an 18% jump in trading profit for the second half of 2020, despite a turbulent year for the retail industry. Shoprite has been reviewing its long-term options across Africa over the past year. That is, currency devaluations, lower commodity prices, and high inflation has eaten away at spending power and weighed heavily on earnings. From Johannesburg, here's Sumitra Naidu.
It was a stellar performance considering all the restrictions around COVID-19. Shoprite lost 79 days of trade in its home base during the liquor bans in 2020, but its grocery stores made up for the losses. Sales in its biggest market, South Africa, came in 5.6% higher.
We gained market share uninterrupted for 22 months now, to the value of 1.3 billion on top of last year's 1.4 billion. In particular, in the fresh food and convenience section of the market, we gained another 400 million in market share. If you exclude liquor in the South African business, we grew the turnover by 7.8%.
Shoprite wasn't as successful in the rest of Africa as COVID-19 constrained trade. Its non-RSA operations fell 8.4%. Angola was hard hit as it also had to deal with its weak currency. Sales there and in Zambia declined over 15%. Namibia and Mozambique also recorded lower sales growth.
Africa at the moment remains a tale of devaluing currencies. So this is the current point in time. I don't know what's going to happen over the next 10 years. It doesn't mean that we would not reinvest again, but maybe with a different operating model.
The last of its stores in Kenya have been closed and the sale of its stores in Nigeria is almost complete.
We don't have a strategy to withdraw from the continent at all. What we did was to look at our individual investments country by country to ensure that we do give our shareholders the return that they require. One can't indefinitely subsidize the foreign operations with the South African rand. We are waiting final approval from the equivalent of the Competition Commission in Nigeria for that sale. We will continue to support the business going forward on a franchise basis in terms of the brand, systems and management over the next 5 years.
Shoprite remains the largest private sector employer in South Africa with over 140,000 employees. The group managed to create another 4,300 jobs in 2020, helping with the onslaught of joblessness in South Africa. Sumitra Naidu, CGTN, Johannesburg.
All right, then let's get back to our earlier interview with Ramah Nyang of AFG Hermes. So Ramah, good to have you back. So you're essentially in the middle of explaining why the argument about essentially keeping rates where they are at the moment needs to be approached with a bit more nuance, because a lot of the earnings that we're talking about are concentrated in the top tier of the market, and the mid-tier and the lower end of the market are essentially facing really compressed margins.
Sure. Look, on principle, I agree with you. If you look at the NIMs that the banks were reporting last year, or even during the rate cap period, there was earning NIMs of 7-8%, which are amongst the highest within the frontier universe. So in that case, you could make an argument that why do they need to price higher? However, the two counter arguments to that is, firstly, if you look at the profitability of the sector, the profits were largely concentrated amongst the top tier banks, the top 8 or 10 banks who have strong deposit franchises and low cost of funding, and therefore were able to offset the lower lending rates. If you go lower down, banks are struggling to make profits to meet their cost of equity, and that's not a healthy situation. So in that case, there is an argument to be made that lending rates need to go higher, especially for tier 2 banks. And then the other point is, yes, the tier 1 banks are making a huge amount of profits, but if you look at the intermediation within the sector, if you look at the deposits to GDP ratio, loans to GDP ratio, it has largely declined since 2016. And the banks have been able to replace that either by growing some of their fee and commission income, or making money off the government through T-bills and bonds and that kind of stuff. So again, I think the idea going forward should be to allow banks to price higher, so that the intermediation within the sector improves. But it is very sensitive. On the one hand, you have to let the rates go higher, but at the same time, you have to make sure they don't go back to the levels they were back in 2016. It's quite a sensitive discussion, and probably that is the reason why, one of the reasons why the central bank is taking its time.
Indeed. One last question for you. In his call earlier today, Joshua Oigara, the CEO, acknowledged that the work of restructuring part of their loan books is far from over. He sees it as a 2-year process. But given the macro uncertainty that the bank operates in, do you think paying that dividend was the right call? Because on one hand, it's easy enough to say, well, we're going to give shareholders close to $30 million, but you're also taking in $100 million in order to lend that out from entities like the IFC. I mean, shouldn't they have just kept the capital?
No, I disagree. If you look at the KCB in particular, at the end of last year, the bank's capital adequacy ratio and the group capital adequacy ratio was at a multi-year high. It was close to around 20%, if not slightly higher at the group level, which is the highest it's been since 2014. At the same time, the discussion we were having earlier, the outlook right now compared to 12 months ago is definitely a lot more positive, as we have more knowledge about the virus, how to contain it, and obviously there's the hope of the vaccine as well. So given that environment, given that the guidance from management is that asset quality, NPL ratios have peaked, I think it would given that context, I think it would have sent out a very negative message if the largest bank in Kenya, one of the most stable banks in Kenya, did not pay a dividend. So I think from a signaling effect, I think it was important for the bank to pay a dividend. It just gives a more reassuring message to its stakeholders and to the wider economy. And in that regard, given where the bank's capital adequacy ratio was at the end of last year, I was actually surprised they paid a dividend of only 1 shilling compared to 2 shillings 50 cents the year before. I was actually expecting a higher number.
And so they essentially split the difference. Rana Gadia from EFG Hermes, thank you very much for your time this evening. Time now for a run through some company news. The African Enterprise Challenge Fund has launched a $1.2 million fund to unlock the potential of renewable energy to create new business opportunities in Kenya. Now, through this fund, businesses and entrepreneurs in the East African nation can apply for funding designed to strengthen the market readiness of innovations they're working on. They will also secure financial, technical and networking support in order to scale up proven or promising prototypes. Kenya's Safaricom-backed ride-hailing firm Little has raised its fares amid escalating fuel costs and pressure from drivers to increase the base rate due to the rising costs of operations. Now, the company currently is charging its consumers roughly 27 US cents per kilometre. Now they'll be paying 30 US cents per kilometre. The firm also charges customers an additional 3 cents per minute and a minimum fare of 91 US cents for every trip. These, however, will remain pretty much the same. And Credit Suisse is facing a number of regulatory investigations of its dealings with the collapsed Greensill Capital. It warned earlier this week that it may take a financial hit after it was forced to freeze a $10 billion supply chain finance fund that it ran with Greensill. The Swiss bank has so far recovered about $50 million of a $140 million loan to the firm. It's also contending with how to deal with investors in the funds and exactly how they will be repaid. That's a run through your company headlines. You're watching Global Business Africa. Time for a break. Here's what's coming up next. Egypt's government plans to increase public spending to boost incomes amidst the pandemic. And the unemployment rate in Nigeria has soared to over 33% amidst this unprecedented pandemic.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, Sharp and insightful. Global Business. Only on CGTN.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference. Welcome back to the program. Let's head over to West Africa. Nigeria's unemployment rate has surged to a record high of 33.3%. Data released by the country's Statistics Bureau shows that 23.2 million people were either unemployed or underemployed in the fourth quarter of 2020. That's up from 27.1% in the second quarter of the year, and it's an indication of just how damaging the COVID-19 pandemic has been on Africa's largest economy. CGTN's Deji Badmus has more on that story.
It's been about 7 years now since Jacob Onuche graduated from the university, but he's not been able to find a job. He's attended several job interviews, but none has landed him a job yet.
I served Nigeria government as a youth corps in 2014. And since then, life has not been the same. You see, you have a younger one that are still looking onto you to become something so that they can tap from you. Your parents are there. They're training in school and they're expecting a return from you. And there's nothing to show up. So what are you saying? See, this is where we find ourselves.
Onuche is just one of the 23.2 million Nigerians the National Bureau of Statistics says are unemployed. Of that figure, the majority are youths of active working age like Onuche. And with the number of graduates entering the labor force every year far outpacing the number of jobs created, it's inevitable the situation could worsen.
If federal government will give advertisement of job opportunity, the company will do the same thing and they'll tell you you must have 5 years experience, 2 years experience, 3 years experience. This is a young graduate that is just coming out of youth corps service.
Economic experts say the current job situation in Nigeria might have been better if the COVID-19 pandemic had not happened. Businesses were forced to shut down and workers laid off at the peak of the pandemic. Many of these businesses are not back, and even those that have come back are still struggling.
And you recall in 2019 August, the lockdown of our borders to neighboring countries in the ECOWAS, also in the Niger, Benin Republic, Togo, and all the rest, also have an impact in this increased labor statistics.
The rising unemployment rate is a big headache for a government that is also struggling to rein in on rising inflation and get the economy back on track following the easing of COVID-19 restrictions. Analysts say the government needs to take drastic actions like giving businesses tax breaks so they could recruit more.
In this process, cutting taxes, we can also put a benchmark on companies that retain or recruit more from this net that we have, that we need to also put back into the labor status, into the labor market, wherein if company A employ 100 number of people within the period Q3, Q4, and retain them for 12 months, you have particular rebates. We believe that all this can also stimulate the economy in the long run.
As for job seekers like Onuche, any policy or strategy that will get him that elusive job will be just fine. Deji Badmus, CGTN, Lagos, Nigeria.
On to Egypt now. Authorities there are planning to increase spending in the 2021-2022 fiscal year that starts in July. This is part of a broader set of efforts to boost the incomes of households in the country and to cushion them from the slowdown in the economy, of course, triggered by the COVID-19 pandemic. This new spending increases the minimum wage for the public sector employees. It boosts their pensions and civil servant salaries. The monthly minimum wage for civil servants, in fact, will go up by 20%. From Cairo, here's Yasser Hakim with the details.
The newly announced budget reflects the state's policies to deal with the adverse effects of the COVID-19 pandemic. Economic growth rate is forecast to remain below the pre-COVID target of 5.5%, although total spending is set to rise by 9% year-on-year. Most of it is aimed at boosting social services.
We see a big increase in expenditure in education, the school and university levels, as well as the same increase in spending on the health sector. This goes with President Sisi's pledge in his second term in office to overhaul and upgrade the health and education services in the country with the aim to improve the quality of life for Egyptians.
Expenses will also be geared towards raising salaries and pensions, increasing social welfare programs for the poor, and emergency aid packages for struggling businesses and institutions. The government is not eyeing any tax hikes in the 2021-2022 fiscal year, but it expects revenues to jump by 13%. This is in spite of the significant drop in important sources of income, such as tourism and exports, which have been battered by the pandemic.
Though he announced no tax increase, the government is seeking to improve tax collection management with better trained tax collectors, incentives for taxpayers, and introducing technology to reduce tax evasion. Another important revenue stream will come from investments in several sectors such as real estate, which is picking up quickly and attracting a lot of investors. We have huge mega projects, building new cities, roads, transport, industrial zones, attracting investments in multiple industries, including renewable energy projects and digital transformation.
Numbers show optimism of a recovery from the pandemic next year, with the budget surplus forecast to more than double, pushing deficit down by 1.2% of GDP. Yasser Hakim for CGTN, Cairo.
So let's delve into the outlook, the macroeconomic outlook for Egypt. Professor Alam Ahmed is the director of the Middle Eastern Knowledge Economy Institute. He's joining us now live from London. Thank you for your time this evening, sir. So back in January, the IMF held the view that Egypt's economy would grow by around 2.8% this year. We're coming to the end of the first quarter. Do you think Egypt is on track to grow at that rate, or should we expect a much better outcome?
Thank you for inviting me. I think let's put this into real perspective and a global perspective. The COVID-19 pandemic is an uncharted, if you like, economic model for the whole world. So everything we taught or we studied in economic cannot be applied here. IMF predictions, normally we use them for macroeconomic policy, for future planning, but really during the last 1 year and for the next 1 year, I have always warned people, IMF and all other like World Bank and all these institutions, we need to be very careful because we can't really predict what is going to happen tomorrow with unpredicted situation. Last night, we've been told in the UK, we're going to have a significant reduction in the vaccine to vaccinate our own people here in the UK, just in April time. Today morning, we've been told the vaccine is coming from India, there's a problem there. What I'm trying to link this to Egypt, we can't really predict any economy in the entire world, how is it going to progress or to go backward. It is really a matter of how we're going to deal with COVID. COVID is a priority, and each country's economic, social, everything, demography is really depending on how the country is going to overcome the COVID-19 pandemic. Just to conclude this part you're asking me, back in 2020, when the Chancellor of the UK was asked in the Parliament about his prediction about the debit, about the GDP decline, he said one answer. He said, now I am only dealing with NHS, which is our National Health Services. Only ask me about saving people's lives. I have an open check for the NHS I want to save lives. After I save lives, then you can ask me about budget. So my answer to you, I don't think we can predict, although Egyptians have done quite a remarkable work. They have injected the economy by, I think, almost 100 billion Egyptian pound. They try to get people out of their lockdown as much as possible. There is lots of good economic activity.
Right, unfortunately.
Economy, but it's still to be very safe.
All right, Professor Ahmed, just based on what you've said so far, one of the underlying assumptions, at least in the budget for the next fiscal year, the one that starts in July, is that tax revenues will also go up by at least 13%, but there are no tax hikes plans, which at least implies that there will be a lot more economic activity that will generate the extra taxes that the authorities are looking forward to. Do you think that's a feasible proposition?
Taking this in light of what I said earlier, it's both ways. Egypt in particular, among the Middle Eastern and North African countries, they have really embarked upon lots of tourist, new resort building. Lots of projects have been going on in Egypt, particularly the new capital administrative city. We hear lots of positive news about Egypt doing lots of buildings. Even in the last 6-8 months, we have seen advertisement of real estate properties and so in Egypt, which is exceptionally not even happening in countries like United Arab Emirates in Dubai. So from that side, it gives a signal there are going to be lots of investment, lots of progress in the economy, which could lead to increase the taxes. But from the other side of the coin, every country is trying to compensate the huge unexpected debt in the budget by raising taxes. But the opposition to high level of taxes is increasing across the whole world. In the UK, for example, we have the same issue here. When the Chancellor said, the only way I have to recover is to raise taxes, he received lots of opposition to that. So the answer is, yes, it's possible, but I don't think any economic advisor will wisely advise the government, macroeconomic policy apparatus, to increase the taxes, because we really need to recover. Every country is going to go through a stage of rebuilding. Rebuilding means you need lots of money for development, for schools, for kids, for poor families. Egypt, the prospects is good, but I think if there is increase in taxes or in tax revenue, I would expect it not to be that significant, but it will be marginally, any marginal increase in the tax revenue, I think, is a positive sign.
Okay, one last question for you, sir. So unemployment rates in Egypt did fall in the third quarter of the year, just over 7%. And the reason I'm framing this in a continental sense is because we're looking at economies like Nigeria, unemployment at record levels there, 33.3%. South Africa, unemployment has also gone up as well. In East Africa, Kenya, unemployment also went up. But in Egypt, it's the opposite trend that we're seeing. How did that happen?
Very good question, Andre. I think this is a very good point. I think in Sudan, for example, the IMF expected 22% unemployment. Yes, in the UK, we lost millions of people. How Egypt did that? There's two lines of resources I have referred to. Some of my colleagues, even the academic professors of economics, they told me Alam is not really that reduced. Others are saying to me, yes, it has reduced Alam. And the most important here, there are good reasons people can attribute to the reduction in unemployment in Egypt. The IMF expected it to be 8.3 or 8.6. Egypt declared by their ministers, which we have to believe that figure, as 7.19, which is even lower than the IMF expectations. So there are lots of reasons. There's lots of projects in this administrative capital. There is lots of money being put into new resorts, building, lots of projects. The government itself injected quite a lot of money, as I said earlier, 100.
Right,
some SMEs.
We've certainly lost that signal to Professor Alam Ahmed there in London. Let's move on to Zimbabwe. The government there is expecting a bumper maize harvest, which could be 3 times higher than the amount produced during the drought hit 2019-2020 season. CGTN's Farai Makutua reports on what this means for the country, which has been battling food insecurity.
Davidson Gambinga began planting his maize crop in November 2020, hoping that forecasts of an above-average rainy season would materialize. They did, and today he's expecting to reap over 30 tons, his biggest harvest in years.
Usually the driest months of the season are January and February, but this year they had the most rainfall. It has been such a good season all over the country that the Grain Marketing Board may not have enough space to store all the grain.
Total national output is estimated to reach at least 2.5 million metric tons. Government plans to raise 65 billion Zimbabwe dollars, that's about 783 million US, to buy up 1.8 million tons of maize. That will be enough to meet annual consumption, and what's left over could be stored in the National Grain Reserve.
This season is very important because it then guarantees that we're going to have food for the coming 12 months, but we are also going to have food in the event of a drought. So the economy, what it means to the economy is that normally when we have a deficit, we will have to import. And importing means foreign currency, use of foreign currency reserves, and that's a drain on the fiscus. But this is an import substitution.
The good harvest will also lower the number of people requiring food and humanitarian aid, currently estimated to be over 5 million by the United Nations World Food Programme.
Given that we have this situation where we're looking at the good harvest and our future food assistance during the lean season will be in all likelihood much lower, it will open up the opportunity for WFP and many other agencies to continue refocusing their investments towards resilience building, towards livelihoods, to really help bolster that capacity of those communities and households to better live with shocks going forward.
Zimbabwe has predicted strong economic growth of 7.4% in 2021, mainly on the back of the rebound of the mainstay agriculture sector. Farai Mwakutuya, CGTN, Mazoe, Zimbabwe.
On to North Africa, where Chinese tech giant Huawei has organized a talent day in Tunisia. Tunisian engineers there have thanked the company for its continued contribution to the North African economy. Huawei's been there since 1999. It's worked extensively with local major telecom operators, government and enterprise clients. Adnan Chouachi has this report.
The Tunisian ICT minister and the Chinese ambassador to Tunisia attended the national event. The two officials hailed the partnership between Huawei and several Tunisian companies in the technology sector.
This Talent Day organized by Huawei is part of Tunisia's strategic vision in the ICT sector. We want to make Tunisia a digital destination.
Huawei has been working for a long time in Tunisia. It's an enterprise which works successfully with the authorities, companies and their Tunisian partners. Huawei also assumes its social responsibility. In addition to economic activity, the training of Tunisian talent, engineers and students is part of Huawei's vision.
Huawei Northern Africa's vice president in charge of public relations for the Mediterranean region explained that the tech giant is committed to making Tunisia a regional digitization center and ICT hub.
Tunisia has an important treasure of skilled engineers. Huawei aims to be a catalyst of change by offering youth the chance to gain access to the latest ICT. This will contribute to Tunisia's development and allow it to shine in the whole region.
We provide high-quality trainings for our interns. We give them a limited access on our iLearning platform in order to cultivate them, enable them, and give them the opportunity to enlarge their knowledge and enlarge their skills.
Those who participated in the event hailed Huawei's role in training and supporting talented Tunisian engineers and engineering students.
This job is very interesting for me. I have learned a lot of things. I have learned to work in group, to know a lot of partners, and to know a lot of colleagues. So Huawei is really opening big opportunities for students, graduated students who have knowledge in all that's telecommunication, all that's routing and switching, artificial intelligence. So I can encourage everyone to join this Huawei ICT Academy program.
Tunisian authorities aim to increase cooperation with China and welcome more Chinese companies like Huawei to invest, develop and succeed in the country. Tunisia aims to promote social and economic development and employment through ICT development. Huawei has trained more than 4,000 ICT professionals in the North African state. Adnan Shawishi, CGTN, Tunis.
You're watching Global Business Africa. Time for a short break. Here's what's on the other side. The US Federal Reserve is predicting a strong economic rebound in the US this year. And Brussels is threatening to block shipments of COVID vaccines to countries that do produce their own vaccines.
Business in Africa is at the crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back to the program. Let's run through some of the stories making your headlines at this hour. Starting with the World Health Organization, it says that the benefits of the AstraZeneca-developed COVID-19 vaccine far outweigh the risks. It's therefore recommended that inoculations using that vaccine continue. The WHO listed the Oxford and AstraZeneca-developed vaccine for emergency use last month. It's believed this will increase access to what is said to be a relatively inexpensive jab for a lot of developing economies. Elsewhere, Zimbabwe's government is expecting a bumper maize harvest. It could be 3 times higher than the amount produced during the drought hit 2019-2020 season. Total national output is estimated to reach at least 2.5 million metric tons. The Finance Ministry plans to raise just under $800 million to buy up 1.8 million tons of grain from domestic farmers. And in Alaska, senior diplomats from China and the United States will be holding their first face-to-face talks since President Joe Biden took office. Beijing's delegation includes Yang Jiechi, Politburo member of the Communist Party of China. Joining him is a Chinese state councillor and Foreign Minister Wang Yi. Representatives from the US side include Secretary of State Antony Blinken and the National Security Advisor Jake Sullivan. This is considered to be a high-stakes meeting between the world's top 2 economies. That's a run through your headlines. Speaking of the United States, the Federal Reserve says the economy will bounce back stronger than forecasts from the COVID-19 pandemic. In fact, it's forecasting growth of 6.5% this year. Don't often get to hear those sorts of numbers from the US. The Fed also signaled it's not expecting to raise interest rates at least for the next 24 months. Here's Giles Gibson from Washington.
The US is giving out millions of coronavirus vaccines every single day. And the Federal Reserve says the economy is getting a shot in the arm too. It's forecasting 6.5% growth this year, raising its last prediction of 4.2% in December.
The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year.
The Fed is also holding interest rates steady at near zero. It isn't expecting to raise rates for a couple of years and will continue its asset purchase program.
US President Joe Biden is traveling the country this week to promote the $1.9 trillion American Rescue Plan. Not a single Republican senator voted for the package, and GOP lawmakers are warning that it could unleash inflation.
The White House, though, says now is the time to go big. As well as $1,400 direct payments, the bill contains money for vaccine distribution, reopening schools and supporting small businesses. As for inflation, the Fed expects it to rise to 2.4% this year before falling again in 2022.
Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%.
With almost 10 million more Americans out of work compared to this time last year, though, the coronavirus comeback is only just beginning. Giles Gibson for CGTN in Washington.
Just over a year ago, the then President of the United States, Donald Trump, claimed that the United States and China had reached what he described as a transformative deal that would reset relations after a trade war. But relations sank to an entirely new low as Mr. Trump blamed China, without evidence, for the COVID-19 pandemic. And the outcome of that deal is now under scrutiny, as Owen Fairclough reports.
A lunch to toast a deal ending a trade war that backfired on Donald Trump.
Hey, this is a great day for both China and the United States.
Under the January 2020 agreement, US exports to China would soar over the next 2 years to redress what the former president deemed a damaging trade deficit. Exports have risen across all sectors, and in 2020, China became the biggest US trading partner once again.
And for some analysts, that's a failure for the Trump administration because the US trade deficit with China narrowed only a little last year. That said, global trade declined everywhere last year due to the pandemic, and that impacts countries with trade deficits.
The deal is now under review by the Biden administration, whose trade representative appears hawkish on China.
I previously served as America's chief enforcer against China's unfair trade practices. I know firsthand how critically important it is that we have a strategic and coherent plan for holding China accountable to its promises.
Beijing was quick to rebuff her comments. As to issues facing the bilateral trade and economic relations, both sides should probably handle them based on mutual respect and equal consultation. We firmly oppose any unwarranted accusations and even stigmatizations against China's normal economic and trade practices. And as the US contemplates its China strategy, free trade advocates are calling for the abolition of tariffs on Chinese imports that were reduced but remain in place. They've been blamed for saddling Americans with tens of billions of dollars in taxes from Chinese import duties. Owen Fairclough, CGTN, Washington.
On to Europe now. Brussels has threatened to block the shipment of COVID-19 vaccines to countries that either produce their own vaccines or that have relatively high vaccination rates. Now, this warning shot comes as the Commission unveiled its plan to introduce digital COVID passports to help ease travel across the bloc. Now, those in the tourism space are hopeful that this could turn things around. But as CGTN's Tony Waterman now reports, they argue that this will only work if governments keep it simple.
Nestled along Brussels Embassy Row is Les Grands Arbres, a B&B Jean-Louis Festeratz and his wife opened in 2019. They sunk $35,000 into converting office space into luxury accommodations, each of the 3 rooms named after one of their children.
We have the Victoria one, the most beautiful one.
But months after flinging open the doors, coronavirus ground travel to a halt. Ever since, business has been sporadic. Some weeks full, then barren stretches for weeks.
Before we had reservation 3-4 months before, and now it's only last minute. And before it was people from America, Canada, everywhere. Now it's only the country around Belgium.
A vaccine passport could be the jolt the EU tourism industry and its 30 million workers need, a way to safely reopen borders, end costly lockdowns, and restore some semblance of normality.
When we travel, we usually carry with us 2 key pieces of documentation, our passport and also our vaccination card. What Brussels is proposing is a digital vaccination certificate that we carry with us on our phones.
COVID certificates in the form of QR codes or paper would be given to people who can either prove they've been vaccinated, recovered from the virus, or have recently tested negative. It would be left up to member states to decide on what privileges it will unlock, like skipping quarantine or testing, which has raised concerns about discrimination.
If we go into using these certificates in other ways, we have to see if that use is necessary, proportionate, and non-discriminatory.
Brussels hopes to roll out the certificates by summer. By then, more Europeans should be vaccinated after a bungled start to immunizations. Brussels on Wednesday saying no options are off the table when it comes to protecting the bloc's supplies, warning the US and UK, which it accuses of hoarding jabs.
If the situation does not change, we will have to reflect on how to make exports to vaccine-producing countries dependent on their level of openness.
As for Jean-Louis Festerarts, he sees the COVID certificates as a way out of night after night of vacancies, but only if politicians can keep it simple. Tony Waterman, CGTN, Brussels.
Now, the ongoing talks between China and the United States do come as tensions on the tech front continue to rise. As Mark Nyang reports, the site of the talks in Alaska may not appear to be a major player in the tech scene, but in some ways it epitomizes what tech's global potential is all about.
I'm from Togiak, Alaska. That is here. The original name of that is Duyuriak. I'm a Yupik Eskimo.
For years, Joel Forbes was part of a singing and dancing group. Today, Joel's a tech worker at the startup 60 Hertz, which provides maintenance software to help people in remote places like where he's from troubleshoot and repair energy systems.
Bringing new technology to the old world, it empowers people to better utilize their skills. They're keeping the lights on in their communities, and this software helps them get that data and make sure everything is running correctly.
60 Hertz went through the program Launch Alaska, which may be the world's only startup accelerator that's actually called a deployment accelerator. The idea is to partner startups with local companies to challenge their technology by taking on everything from rough terrain to harsh weather conditions to the high energy costs of Alaska.
We have a lot of really tough conditions, of everything from hot to cold. We have more coastline than the rest of the U.S. combined. If you're trying to sell into the electric grid space, we have over 200 independent islanded microgrids. We have one of the world's premier flying communities, so if there's anything that you're trying to do in the air, whether that's UAVs or manned systems or aviation tech, Alaska is kind of the premier, testing ground.
Now, Alaska appears to be the testing ground for high-level talks between Chinese and U.S. officials. Vandenberg hopes thorny issues over tech will be discussed because it will help address other problems like climate change.
To solve these kinds of problems, we need minds and talent and tech from all over the world. And also, we need our entrepreneurs to be able to access markets anywhere in the world. So we very much sit on the side of, free trade.
Tech tensions between the two countries heightened after the Biden administration designated 5 Chinese tech companies, including Huawei and ZTE, national security risks. Chinese officials say this move was counterproductive and will harm U.S. companies too.
I think tech should be the frontline topic for this dialogue. If anything, I think the technology topics are the front line of the China-U.S. tensions. Of course, several years ago, the U.S.-China tensions started with a trade war. But as the trade war evolved, we find that the technology-related topics increasingly become the front line.
Ma, who now lives in New York, came to the U.S. as a student from China more than 20 years ago, with his first stop being Alaska.
It's a great place for this conversation to happen. And so to me, Alaska is such a connecting point.
A literal and figurative connecting point over how the two most powerful tech nations in the world can both lead and compete in a digital economy. Mark New, CGTN, Anchorage, Alaska.
A good run through commodity prices for you. So Brent crude prices seem to be falling rather sharply today, partly due to renewed dollar strength, but that is not the entire story. At 17:15 GMT, futures due in May, we're trading around $64.50 a barrel, down 5.1%. Across the pond, WTI crude fell by an even larger margin, down by over 6%. Now, in part, traders are pointing to a rather shaky outlook for demand, given the slow or inefficient rollout of vaccines and, of course, the vaccine nationalism we're seeing playing out in key markets around the world. Now, let's move on to something that's the complete opposite of the oil market: electricity and vehicles driven by electricity. Nigeria has launched its first locally assembled electric car, but challenges like inadequate, inconsistent supply of power and a lack of resources for the average Nigerian to own such a car may pose a setback. From Abuja, here's Phil Ihaza on Grassroots.
It's not the regular car. It's the Hyundai Kona, the first electric car assembled in Nigeria. Launched in February this year in Abuja, the makers say it has taken more than 10 years to achieve this feat.
It's all about just plug it at your house. You have a section in your house that it will be installed. Plug it there, go to sleep. Next morning your car is charged, just like your phone. Driving free without fuel. It makes the ecosystem free, fair for all to breathe in fresh air. This exhaust pipe emitting gas, emitting smokes and all the rest is not there.
The world is gradually moving to electric cars as a way to reduce carbon emissions and pollution from fuel combustion. It's a huge milestone in Nigeria's automobile industry because car owners can start driving electrically powered vehicles rather than the conventional fuel engines. But there's a challenge. Nearly half of Nigeria's population lacks access to electricity, plus the electric car is priced at about $63,000, almost double that of a fuel engine. But nonetheless, some customers are thrilled with the car.
The idea in itself, I think, is brilliant. And I really like what I'm seeing right now. The cost of it, I mean, is still debatable, but still a very good thing.
Also, the makers say this first invention can go as far as 500 kilometers, enough to go around Abuja city for a day.
Presently, it has about two. The first one is the one that powers up the lighting, starts up the car, turns on your AC. The second battery helps to repower that same battery. So repower that same battery helps the car to be at least it cannot never get to 0.0. There will always be power available. There will be room for improvement. So that improvement is what Nigerians will definitely get to enjoy over time.
About $500 million has been approved by the World Bank for Nigeria to improve its electricity supply, thereby increasing the productivity and earnings of citizens.
The hope is that many Nigerians can own cars like this so that the country could be on its way to achieving a more eco-friendly environment, just like many developed countries around the world. Phil Ihaza, CGTN, Abuja.
Let's wrap up the program with a focus on currencies. Egypt is, of course, holding its rate-setting meeting today. The central bank's monetary policy committee has basically held rates exactly as they are. This is the third time that they're doing this. Essentially, the deposit rate remains at 8.25%. The lending rate remains at 9.25%. At these levels, given where headline inflation is at in Egypt, these are some of the highest real rates in the world at the moment, and it's done a world of wonder in terms of attracting capital to come into the capital markets. It's also been pretty fantastic for the currency, the Egyptian pound holding steady around the 15s or so to the US dollar. That's it for this edition of Global Business Africa. Remember, we'd like to hear your thoughts on the content you've seen on the program in the last hour. There are many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today is up next from Washington, D.C.